everyone, and welcome back to Bonnie's Life, the channel where we cut through the noise and give you the unfiltered intellectual edge you need to navigate these chaotic markets. Today, we're tackling the million-dollar question, or perhaps the multi-trillion-dollar question. How in the world do you trade this market? We're seeing a perfect storm of geopolitical turmoil, extreme market fear, and technical indicators that are frankly giving everyone whiplash. It feels a bit like trying to solve a Rubik's Cube in the middle of an earthquake, doesn't it? But fear not. Whether you're a long-term holder trying to protect your capital, a mid-term swing trader looking for opportunities, or a short-term day trader, seeking those quick profits, this episode is for you. We're going to dissect the current state of the crypto market, conduct a deep and necessary analysis of the escalating conflict between the US, Israel, and Iran, and then, most importantly, lay out actionable strategies and technical setups to help you not just survive, but potentially thrive. So grab your coffee, silence your notifications, and let's get into it. All right, let's first get our hands dirty with the raw data. As of today, February 28th, 2026, the global cryptocurrency market capitalization is hovering around a shaky $2.31 trillion. That's a significant figure, but it represents a market that has shed over $128 billion in value in the blink of an eye following recent geopolitical escalations. The 24-hour trading volume stands at about $106 billion, which tells us there's a lot of movement, a lot of panic, and a lot of repositioning happening across every major exchange. Bitcoin, our market's formidable king, is currently priced at approximately $64,981, according to CoinGecko. This is a far cry from its all-time high of over $126,272 back in October 2025, representing a painful 48% drawdown. When the king bleeds, the whole kingdom feels it. Ethereum is trading at just over $1,901, showing significant weakness and underperformance relative to Bitcoin. Solana is down at $80.78. XRP has dropped to $1.32 with a brutal 8.8% weekly decline, and BNB sits at $604. Bitcoin's dominance is strong at 56.1%, indicating that in times of uncertainty, capital flees from altcoins and consolidates into the most established asset, which is a classic defensive move in the crypto space. This is not a market where you want to be chasing the latest meme coin, my friends. This is a market that demands respect and discipline. Now let's talk about sentiment, because the numbers only tell part of the story. If the market had a mood ring, it would be glowing a deep, dark black right now. The Crypto Fear and Greed Index, a critical metric for gauging market sentiment that aggregates data from volatility, market momentum, social media, surveys, Bitcoin dominance, and Google Trends, is currently sitting between 11 and 14. For those of you who are new here, that's not just fear. That is extreme fear. We haven't seen readings this low since the depths of the 2022 bear market. This level of panic is where capitulation happens, where retail investors throw in the towel, sell at a loss, and swear they'll never touch crypto again. But here's the thing, and this is important, it's also where the bravest and often the most successful investors start looking for opportunities. Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful has never been more relevant. The smart money understands that maximum financial opportunity often lies at the point of maximum pessimism. We're not necessarily at the absolute bottom yet, but we are certainly knocking on the door. To add another layer to this complex picture, we need to look at the derivatives market, which often tells a story the spot market doesn't. According to data from CoinGlass, we've seen a massive surge in liquidations, with over $521 million in positions wiped out in just 24 hours. That's a 129% increase from the previous day. A staggering $420 million of that belonged to long positions. Traders who were betting on the price going up. Over 152,000 individual traders had their positions forcibly closed. This is a brutal cascade of forced selling that drives prices down even further in a vicious feedback loop. Simultaneously, the coin-denominated open interest in Bitcoin has actually increased from 668,000 to 687,000 BTC. This is a fascinating and counterintuitive metric. It means that despite the price drop, more capital is entering the derivatives market, suggesting that sophisticated players are building positions. The total crypto open interest has dropped from around $140 billion in January to approximately $90 billion at press time, reflecting the broader deleveraging. The funding rate for perpetual contracts has plunged to a 3-month low of -6%. A negative funding rate means that short sellers are paying a premium to long holders, which can create the perfect setup for a powerful short squeeze if the market finds a bottom and starts to reverse. If Bitcoin were to break through $68,499, the cumulative short liquidation intensity on major exchanges would reach a staggering $1.29 billion, according to CoinGlass data. This is a highly combustible situation, and we are watching it with extreme focus. We cannot analyze this market in a vacuum. The single biggest driver of this recent crash has been the dramatic escalation in the Middle East. On Saturday, February 28th, the United States and Israel launched a joint military operation, codenamed Epic Fury, against Iran. President Trump stated the strikes were aimed at ending a security threat to the United States and ensuring Iran could not develop a nuclear weapon. Israel's defense minister called it a preemptive strike. This is not a minor skirmish. This is a direct confrontation between major global and regional powers. The targets included Iranian leadership and key military and regime sites in Tehran. Iran has already retaliated with an unprecedented wave of missile strikes against US and Israeli targets across the Middle East, with explosions reported in the UAE and Qatar. Israel has shut down its gas fields in response. This is the most significant military escalation in the region since the war in June of 2025, and its shockwaves are being felt across every asset class on the planet. Immediately following the news, risk assets took a nosedive. Bitcoin plunged almost 5% in minutes, dropping to a low of $63,038 before stabilizing around the $64,000 mark. As one prominent crypto market watcher posted on X, Bitcoin just dropped off a cliff. Monday will be a bloodbath in the market as the flight to safety will accelerate. This event has, for now, shattered the narrative of Bitcoin as a safe haven asset, a digital gold. In this moment of acute geopolitical crisis, Bitcoin has behaved like a high beta risk asset, much like a tech stock. As Rania Gul, a senior market analyst at XS.com, astutely noted, in moments of existential risk, investors return to assets that have historically preserved value. Bitcoin, despite the digital gold narrative, has not yet proven itself as a safe haven during sharp geopolitical shocks. Its recent behavior indicates that it is still priced as a high beta risk asset sensitive to global liquidity flows. In contrast, actual gold is on a record run, up 22% this year, with analysts predicting a potential surge to between $5,500 and $5,800 an ounce if the conflict prolongs. Bitcoin, on the other hand, has shed over 25% of its value in the last 2 months. This is a crucial lesson for all of us. Narratives are powerful, but they must be validated by market reality. And right now, the reality is that Bitcoin is not the safe haven many hoped it would be during a hot war. The implications of this conflict are far-reaching and will reverberate through markets for weeks, if not months. The Strait of Hormuz, a critical choke point through which about 20% of the world's oil supply passes, is now effectively a conflict zone. Several major oil companies and top trading houses have already suspended crude oil and fuel shipments through the strait, according to Reuters. Brent crude prices, already up 20% this year at around $73 a barrel, are projected to hit $80 in a contained conflict or even $100 a barrel if the war is prolonged, according to William Jackson, chief emerging markets economist at Capital Economics. A sustained conflict affecting oil supply could add 0.6 to 0.7 percentage points to global inflation, he said. This will pour gasoline on the fire of global inflation, limiting the ability of central banks like the Federal Reserve to cut interest rates. The Fed has already left rates unchanged to start 2026, and a March rate cut, which the market was desperately hoping for, is now considered a coin flip, according to Fed Governor Christopher Waller. Markets are now pricing in only 3 rate cuts for 2026, potentially starting as late as September. This macroeconomic pressure, combined with ongoing trade tensions and President Trump's aggressive tariff policies, including 25% tariffs on autos, auto parts, steel, and aluminum, and 10% tariffs on Chinese imports, creates a brutal headwind for risk assets like cryptocurrencies. The VIX Volatility Index has risen by a third this year, and the MOVE Index measuring bond volatility is up 15%. The market is being squeezed from all sides: geopolitical fear, macroeconomic tightening, and internal technical weakness. So, with all this chaos, what are the charts telling us? Let's put on our technical analysis hats and identify the key levels that will define the next phase of this market. The dominant structure on the Bitcoin chart is a clear and brutal bear market. We are in a sustained correction, and anyone who tells you otherwise is either lying or not looking at the data. Bitcoin is on its worst 5-month losing streak since 2018, with February alone showing a decline of over 16% and $3.8 billion in ETF outflows. The price is trading significantly below its 200-day and 365-day moving averages, which are fundamental indicators of a long-term downtrend. CryptoQuant's bull market score sits at a dismal 20 out of 100. More worryingly, we are seeing the formation of a death cross on the 3-day chart, where the 50-day moving average is about to cross below the 200-day moving average. Historically, this has often preceded the final most painful leg down in a bear market. This is not something to take lightly. However, it's not all doom and gloom, and this is where it gets interesting for traders. The market is currently testing a major support zone around the $60,000 to $63,000 level. This is a critical psychological and technical threshold. If we can hold this line, it could form the basis for a significant bounce. The relative strength index on the daily chart is deep in oversold territory, suggesting that the selling pressure may be reaching a point of exhaustion. Combined with the extreme negative funding rates we discussed earlier, the conditions for a powerful short squeeze are undeniably present. A break above the immediate resistance at $70,000 and more significantly at $72,000 could trigger this squeeze and send the price rocketing back towards the $80,000 region. This is the primary bull case scenario we are watching for. The bear case, however, is equally compelling. A failure to hold the $60,000 support level would open the door to a much deeper correction. The next major support levels are at $57,800 and then the psychologically significant $50,000 mark. Some flow analysis models are even suggesting a potential bottom as low as $31,500. While that may seem extreme, in a market driven by this much fear and leverage, such a move is entirely within the realm of possibility. The key trigger for this bearish scenario would be a decisive weekly close below $60,000. That would signal that the sellers are in complete control and that a new wave of capitulation is likely. The market is therefore balanced on a knife's edge, and the direction it takes from here will likely be determined by the confluence of geopolitical developments and the battle between buyers and sellers at this critical support level. Now, for the most important part of this entire episode, how do we actually trade this? The strategy you employ must be tailored to your time frame and risk tolerance. There is no one-size-fits-all answer, and anyone who tells you there is should not be trusted. For the long-term trader, the investor with a horizon of years, this is not the time to panic sell. This is the time for strategic accumulation. You are not trying to catch the exact bottom. You are trying to lower your average cost basis during a period of extreme fear. A dollar-cost averaging strategy is your best friend here. Instead of trying to time the market, you should be deploying capital in small, regular increments. Consider setting buy orders at key psychological and technical support levels: $60,000, $55,000, and even as low as $50,000. If the market does dip to these levels, your orders will be filled, and you will be accumulating assets at a significant discount. Remember, your time horizon is years, not days or weeks. You are betting on the long-term adoption and value accrual of this technology. Every previous bear market in Bitcoin's history, every single one, has been followed by a new all-time high. the current geopolitical and macroeconomic turmoil is, from your perspective, a temporary storm that is providing a generational buying opportunity. Do not try to be a hero. Be patient, be disciplined, and stick to your plan. For the mid-term trader, the swing trader with a time horizon of weeks to months, this market offers high-risk, high-reward opportunities. Your goal is to capture the major swings within the broader trend. The key is to wait for confirmation. Do not try to catch a falling knife, because in this market, that knife is made of molten lava. The primary trade setup you should be looking for is a bullish reversal pattern at the current support zone. This could be a double bottom, an inverse head and shoulders, or simply a strong bounce with high volume. Your entry trigger would be a decisive break and hold above the resistance level at $72,000. This would confirm that the short-term bottom is in and that a potential short squeeze is underway. Your target would be the next major resistance zone around $80,000, which represents a potential 10 to 15% gain from the entry. You must use a stop loss to manage your risk. A close back below $68,000 after your entry would invalidate the trade and signal that you need to get out immediately. On the bearish side, if we break below $60,000, you can look for a shorting opportunity targeting the $53,000 to $50,000 range. Again, patience is key. Wait for the market to show its hand before you commit your capital. For the short-term trader, the day trader, this is a paradise of volatility, but it is also a minefield. Your focus should be on the lower time frames, the 1 hour and 4 hour charts. You are looking to scalp small profits from the intraday price movements. The extreme negative funding rate offers a particularly interesting opportunity. You can look to open long positions and collect the funding payments from short sellers. However, this is a risky strategy as you are trading against the prevailing trend. A more prudent approach would be to trade the range. Look for buying opportunities at the bottom of the current range, around $63,000, and selling opportunities at the top of the range, around $68,000. Use tight stop losses and take profits quickly. Do not get greedy. In this environment, a series of small, consistent wins is far better than trying to hit a home run. Pay close attention to the order book and liquidation data on platforms like CoinGlass. A sudden spike in liquidations can often signal a short-term price reversal that you can trade. This is a game of speed, precision, and disciplined risk management. If you are not an experienced trader, I would strongly advise you to stay away from short-term trading in this environment. The volatility can and will destroy undisciplined accounts. Before we wrap up, let me quickly outline the key global events that will shape the market in the coming days and weeks. First and most critically, the evolution of the US-Israel-Iran conflict. Any escalation, particularly any disruption to oil flows through the Strait of Hormuz, will send shockwaves through every market. Second, the US jobs data coming out next week will be closely watched by the Federal Reserve and will influence their March rate decision. Third, President Trump's tariff policies continue to create uncertainty, with the Supreme Court recently ruling on the legality of certain tariffs. Fourth, the $8.7 billion in Bitcoin and Ethereum options that expired on February 27th have already created significant volatility, and the market is still digesting that event. Fifth, OPEC Plus is considering a larger oil output boost in response to the conflict, which could partially offset the supply disruption. And sixth, the ongoing tech sector sell-off, driven by AI disruption concerns, continues to weigh on risk sentiment across all markets. Each of these events has the potential to move the market significantly, and you need to be aware of all of them. So there you have it. We are in a deeply fearful, technically weak, and geopolitically charged bear market. It is a treacherous environment, but it is not without opportunity. We have identified the key market indicators, the profound impact of the conflict in the Middle East, the critical technical levels to watch, and most importantly, we have laid out clear actionable strategies for long-term, mid-term, and short-term traders. The coming days and weeks will be critical. The battle between fear and opportunity is raging, and the outcome is far from certain. But by staying informed, remaining disciplined, and adapting your strategy to the ever-changing landscape, you can navigate this storm. Thank you for joining me on Bonnie's Life. If you found this analysis valuable, Please smash that like button, subscribe to the channel, and hit the notification bell so you never miss an episode. Stay safe, trade smart, and I'll see you in the next one.